Hi there, Honest Money. Hoping you guys could help me understand more about gold. So you've got physical gold, you've got gold ETFs, and you've got gold shares. Which one do we buy, and what's the difference between all of them anyway?
Well, I really appreciate the golden question you've asked us about the different kinds of gold investments. And so let's kick off. You asked about the difference between gold, actually buying physical gold, buying gold exchange traded funds, and then buying gold shares. So I think maybe just to start with gold shares. Typically, when you buy what's called a gold share, you're actually buying shares in a company, a mining company that mines gold and sells gold on to its customers. So you're buying a business, and that business happens to be in the business of mining and more specifically mining gold. And to me, to understand a gold mining business, you have quite a lot at play. So you need to understand what's happening with the gold price. Where are we in the gold cycle? Because gold, moves in very big cycles, and generally, when the world is fairly peaceful, the economies are going well, the world populations in general are feeling quite confident and positive about life, you'll find that the price of gold will generally be quite low. However, when things are hugely uncertain, whether it's an economic crisis, a war, a financial markets meltdown or something like that, you'll find that the price of gold will start to rise. And you might also find that if economies are doing well, but people are very worried about global inflation, that they will also buy gold because they believe that gold is a hedge against inflation. So in those situations where gold prices are rising and miners are able to sell their gold at very good prices, you'll find that owning a gold mine share then is a really good idea, because gold mines will typically then be generating lots of profit in a very short space of time, and generally they'll pay out those extra profits as dividends. So very lucrative to own the gold mine in that situation. The problem with owning a gold mine is that gold prices, because they move in such big cycles, you'll find that there will be long periods of time where you won't be making much money from your gold mining shares at all. There'll be times when those mining houses are losing money, and then you're not getting dividends, nor is the price rising. And so it can be quite an unpleasant, uncomfortable thing to own a gold mining share, because then you're not getting real reward at all for being an investor in that company. So if you're going to buy a gold mining share, you need to be a very active investor. You need to be on the money in terms of buying the share when gold prices are down, hopefully just before gold prices start to turn and start to rise. I'm not sure that I want to be owning a gold mining business when we're at the top of the market for gold mines, which means that every other kind of sector in the markets, in the stock markets, are going badly, because when there's lots of fear, lots of uncertainty, and the price of gold mining shares are very high, that's not the time for me to buy, because the only way from there is going to be down. Whether it's down next week or next month or next year, I'm not sure, but I don't think I get a lot of reward for buying a gold mining share when it's really at the peak of its price. So in general, I'm not a big fan of buying gold mining shares, simply because they are so cyclical, and I don't like owning cyclical shares at the best of times. So I tend to avoid most mining shares anyway, and definitely gold mining shares. If we talk then about the other two forms of owning gold, the one will be owning physical gold. So in other words, you go and buy gold bullion or gold coins, and you go and store those in a safe somewhere, hopefully not under your mattress. And the idea there is that you're owning gold as a hedge against a few things. One is against the collapse of all financial systems. Whether you're living in a country where the entire country's financial system collapses. If we think about Zimbabwe over the last 2 or 3 decades, that would be a very good case in point, where someone who owns a lot of gold would have come out of that crisis much less severely affected than people who only owned financial assets. So gold there can be a very nice hedge against an economic system collapse. It's also going to be a good hedge against inflation and uncertainty and those kinds of things. But the thing to know about that is when you own gold in its physical form, you need to know that it's generating no interest, no dividends, no kind of return other than it sits there and if you decide to sell it, you need to find someone that's going to buy that gold from you at a higher price than you paid. That's the only time you're going to make money out of your physical gold. So I think a lot of people might own physical gold when they live in very volatile countries, they live in very volatile markets and the like, and they want some kind of a physical hedge against that volatility. For the rest of us, I'm not convinced that we need to own physical gold at all. I'm always worried about the possibility of theft, especially if gold represents 5 or 10% of your total assets. And someone steals that from you. I mean, that's it. It's impossible to trace. So, again, not a big fan of physical gold at all. The last question then is around gold ETFs, gold exchange traded funds, and certainly South Africa was one of the forerunners and one of the early innovators in owning gold ETFs and launching them and attracting a lot of money. And the interesting thing there is that you don't pay any costs to store that gold in a safe or something. You buy an exchange traded fund. If you buy the ETF, and an important point here, an exchange traded fund as opposed to an exchange traded note. So if you buy an exchange traded fund, then what you know is that gold is actually physically being stored in vaults, maybe in 2 or 3 different locations. And then when you buy your 1,000 rands worth of a gold ETF, you know that you actually have that physical gold that's being stored somewhere on your behalf. So I like the idea of buying an exchange-traded fund in that owns gold as opposed to an exchange-traded note. The reason for that is that if you buy an exchange-traded note, there is actually no physical gold being held, to back up the value of that note. All that it is a contract that's issued to you usually by a bank that says we promise to pay you the price of the gold, exchange traded note. So if you paid R1 per ETF or per ETN, and the price goes up, then your hope is that the bank will then pay you that higher price in the future. So you don't have physical security of your asset. What you have is the risk of that bank falling apart, and then you're not getting the value of your ETN. So if you're buying gold as a hedge against big inflation risks and the collapse of systems and the risk of big banks falling over and all of those things, then to me an ETN is no value at all, because you're not actually hedging against the thing you're most concerned about. So in that situation, I would rather buy the ETF. I think also important to note then is that an ETF will not pay you any interest, any dividends, or any kind of return other than the price rising or falling. So if you're going to buy gold as a hedge, against inflation and those kinds of things, I understand your point. I think there are better ways of doing it. But if you're going to do it, then make sure that you limit the exposure. You don't want it to be 20 or 30 or 50% of your assets, because those assets are absolutely dead while you own that. In other words, you're not earning any interest or dividends or any rent or anything. So it's just a dead asset sitting there, and you hoping that the price will rise. So if I look at an example of the world's wealthiest families, right around the world, they might allow physical assets, physical commodities like gold and silver and platinum and precious metals in general to account for 5, maybe at maximum 10% of their assets. They will never allow it to be much more than that. And they really own it in their portfolio as a form of insurance. It's not really there to generate growth. It's simply there as a form of protection against big systemic collapses. So if you're going to have it for yourself, then maybe that's the maximum you should have. Beyond that, you need to understand that you're owning an asset which you need to trade aggressively. And history tells us that very few individuals, professionals, corporates can trade successfully over time. So I'm not a big fan in general, but I get the view that some people want to hedge against the ultimate collapse of systems, in which case maybe the ETF is the way to go. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.